We are entering into a global recession, which means that people might just lose their jobs in a massive scale. Companies might just go under, and you might just have found yourself in a world where the global economy has taken a turn for the worse. So what does this mean and how does it affect you? In this video, we will go through what you can do and which effects a recession might have on you and the world globally. So make sure to stay tuned until the end. I'll have some guidelines and tips for you as always. I'm Aatlas and welcome to World of Finance. What's up everybody, my name is Aatlas and in this video we will talk about this coming recession, how you should prepare for it, more importantly what it means to the global economy and how it affects you. We will also talk about how you should save, protect and invest your money, so make sure to stay tuned. I'm Aatlas and welcome to World of Finance. What's up guys and welcome to World of Finance, where we as always seek to improve your financial situation through education. So today we're going to talk about the current recession and how to make the best out of it, because when life gives you lemons, you make lemonade. So first of all, if you don't have any excess money, don't worry. But the last thing that should be on your mind right now is investing. I know it's hard to miss out on all these opportunities that might arise in a recession, but it's more important that you cover your living expenses, which lead me to the emergency fund. You should have created some kind of emergency fund where you have 3 to 6 months of living expenses in it. If you're really ambitious, you go 12 months, and it's exactly for purposes like this. If you're, for example, laid off your job, you have some kind of cushion to manage through the crisis. So make sure to create some kind of emergency fund if you don't have any excess cash at the moment. I've created a video on this very topic. There should be a card up on the left corner that you can click if you want to learn more. If you lost your job, if the worst possible thing could happen and the recession claims your job, make sure to register at the unemployment office. This may vary from country to country, but each country should have some kind of benefit or relief program. So make sure to sign up for that if you lost your job. If you, on the other hand, do have a couple of bucks to spare, here are a couple of things that you should avoid. So the first thing that you should avoid is withdrawing your money from the bank. Unless you have a fortune of over $250,000 in your bank account, you won't lose any money if the bank goes under. Your money are FDIC approved, so there's some kind of security there. So make sure not to withdraw your money. People do this because they panic in a recession. They're fearful of the bank's liquidity and ability to pay out their money. But as I said, your money are FDIC approved up to $250,000, at least in the US. So do not panic and don't withdraw your money. So the second thing you should avoid is within the realm of investing. You should definitely avoid panic selling. So many people get rich because they buy up the shares at a so low price because people panic sell. But this does not mean that you shouldn't sell at all. Some companies you most definitely should sell because we're dealing with something called the falling knife. And if you think the company are going to zero and all your analysis indicates that this company is going under, you should definitely sell. But in most cases, people act out of emotion and sell due to panic. You should definitely avoid this. And as Warren Buffett says, be fearful when people are greedy, but greedy when people are fearful. But what if you don't know how to analyze a stock? What if you don't know the difference between a fundamental analysis and a technical one? I don't want to get technical, little pun for you, but then it's the time now to invest in your education. And I'll leave a couple of free audiobooks down in the description below, along with a couple of suggestions that I think you should check out. And I want to stress the importance of having cash on hand, precisely for moments like this, because during a recession is where huge opportunities arise. So you should be able to take advantage of these opportunities, but that demands that you have cash on hand or at least liquid assets that you can liquefy. So let's look at the history of recessions. Just to give you a quick overview and feel of what's to come. Remember that in the stock market, historical data isn't a predictor, but a guideline on how the markets behave. And hopefully this will ease you a little bit and prevent you from making colossal mistakes like selling due to panic. We're going to start off with the 1907 bank crisis, where the stock market dipped 50%, and this was due to a massive earthquake in San Francisco, which led to a huge insurance payout. The insurance companies had to withdraw a lot of gold from the banks, which led the public to question the bank's liquidity. And at this point, the general population began to withdraw money from the bank, further squeezing the banks, which in turn led to this massive dip in the stock market. After this huge dip in the stock market, The public eventually regained their trusts, and the market eventually ended up rallying around 193% in around 4 years. Then came the Great Depression of '29. And there's a lot of different theories of what went wrong here, but one main one is that when the stock market showed some kind of vulnerability, the people in general just started selling, which led to a massive fall. The bank had to deal with a large scale withdrawal, which they couldn't keep up with because they wasn't liquid enough. In total, the market lost a value of 83% in around 3 years, and the unemployment rate rose to almost 25%. After the Great Depression, we saw a long period of growth and prosperity. This was amazing. We actually saw a period of 14 years of growth with a rise of value in the stock market at 816%. Next up is the Second World War. It had a positive effect at first because it created a lot of jobs and decreased unemployment. But after the Second World War ended in 1945, there was actually a dip in the market of 22% over a period of 6 months. And this can be explained because the veterans had to come back home and compete for the jobs. But after that dip in the market, we actually saw a really good growth period of 15 years where the market rose 936%. Then came 1973 to 74. At this point, the stock market experienced a dip of 40%. And this was due to Nixon taking the US off the gold standard. This made inflation go crazy, but eventually they were taking regulatory actions to compete this. After that, the stock market regained public trust, and we saw a period of growth for 13 years with a rise in prices of 845%. The biggest crisis ever is you not smashing that like button, and if you haven't already, remember to subscribe and hit the notification as well. Then came the infamous Black Monday of '87, where the stock market saw a whopping 22% dip in a single day. Not so long after that, we saw the stock market regain public trust yet again, and we had a growth period of 13 years with a whopping 816.5%. Then came the dot-com crash of '01. And in this period, we had a 2-year period actually where we were in a recession, where we saw a dip in prices of 44%. Surprisingly enough, we saw a rise in prices again of upward 108% over 5 years. Then came the Great Recession of '09. And here we actually saw a whopping dip in the market of almost 51% occurring in a little under 1.3 years. And surprisingly enough, the '09 crisis, which were one of the most savage recessions we've ever had, not counting depressions, led to a bull market. One of the most profitable bull markets in history until now. In this moment that I'm filming this video, the S&P 500 has dipped a whopping 28.91% just this year. If you want to learn more about these depressions and recessions, I'll leave a link down below. We can clearly see that there are some kind of patterns in the market. Every time there's a dip, a rally occurs. And this is something that is widely understood within technical analysis. In technical analysis, we have something called a pullback and a rally. And it's a pattern that shows itself throughout the history of the stock market. Every time we have a pullback, we will most likely get an equal response in the form of a rally. And I will show you a chart, it should be here probably in the left lower corner, of a chart of 1994 to 2011, where you can see that every time there's a major pullback, there will occur some kind of rally eventually. So you shouldn't be worried unless you're invested in single companies. If you're invested in ETFs, you shouldn't be worrying. You probably have a long-term investment strategy which you should follow. So don't panic and don't sell. In the end, your actions should always reflect your risk tolerance and your investment horizon. I will cover in later videos how you can determine your personalized investment strategy, your time horizon, and your risk tolerance. So make sure to smash that like button, and if you haven't already, subscribe. Also, click the notification bell as well so you get notified every time I release new content. What have we learned from this video? We have learned that if you're a long-term investor, do not panic. The market will most likely recover. If you're a short-term investor, you should be very vigilant of what kind of investment or assets are in your portfolio and whether or not you should divest or invest. You should always do your own due diligence and make sure that you act with logic and not emotion. because this can actually be one of the more profitable periods in your life if you know how to control and act and behave. Are we in a recession or depression? Actually, we can't even determine that we are in a recession right now, because the definition of a recession is that the GDP has to be negative for 2 consecutive quarters. If we look back to 29 and all the crashes that follows, the general recession/depression lasts for around 1.4 years, and the general accumulative loss was 41%. So now you have some kind of idea of what to expect from a recession. Remember that nothing's for sure, that all historical data is only used as a guideline and not as a definite indicator of what's going to happen. There will always be some sort of risk associated with investments, so make sure that you know your risk tolerance. I promised you guys a quick bonus or a quick tip. Here's a quick tip. During a recession, if you're not a financial wizard, like most of us, you should probably invest in an ETF. If you invest in something called an ETF, you are basically investing in multiple companies and spreading out your risk and making sure you're diversified. I would suggest the SPDR 500 or the SPY if you search it in the tab bar. This is an index that follows the S&P 500, which is probably the more secure choice instead of just picking out a specific stock. Remember that this is just my opinion. I'm not a financial planner. Make sure always to consult one before making any major investments, and remember that there's always some amount of risk associated with investments. So I hope you enjoyed this video that I created for you guys. I hope you got some value out of it. If you did, please do leave a comment down below with a quick timestamp so I know which specific part of this video you found helpful. Also, remember to smash that like button, subscribe if you haven't already, and the notification bell as well for you guys who want to get notified every time I release new great content. I see you guys on Friday. I'm Aatlas, and this is the World of Finance. Shoo!